short of it is
Absolutely. How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals and things like that.
So I think it's really important to be ethical and to be paying them well above.
Innovators is that, when you look at a property perspective, it's a Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Good evening, everyone, and hello from Bali. If you can hear me, please say g'day. It would actually help me out a lot because I'm a little bit worried about the video today. And I was saying to my partner yesterday, I was saying that I've chosen a topic that's very intensive with some graphics and stuff to help you understand it, with probably the most unstable internet connection I've ever had for a live show. So we're going to attempt the remarkable tonight. And if you are joining us live, which I know some of you are, please comment in the comment section. Tell me where you're coming from, where you're joining us from. I'm hopeful that I will start to see comments soon. My connection's not as stable as the rest of y'all, so hopefully it works out. If you can hear me, please let me know. And while you do that, I am actually going to, why don't I share with you what I've been reading? So what I've taken away with me on the road. So I'm just going to bring something up, 1 second. So normally when I get to go away, it's the best time for me to read some books, because otherwise I just get distracted with home, with work, with basically everything that's going on. So I can see Matt's reporting in from Brisbane, Semi Bluff from Ballarat, Heather from Adelaide, coming through loud and clear to NT. NT's not too far from where I am, surprisingly. It's a lot closer than Melbourne is. Hi from Melbourne, says Jane. G'day, everyone, and good evening to you. So the three books that I've got that I've taken away with me, the first one is The Ulysses Contract by Michael Kemp. I'm hopeful Mike will come on the show in the next maybe couple of weeks or couple of months. Mike's a great guy. Many of you will know of him, and there was a few comments a couple of weeks ago about getting him on the show. Mike's the guy who many of you may know from the Barefoot Blueprint community, if you were part of the Scott Pate Barefoot Investor community a few years ago before it closed down. So Mike led a lot of that investing research. The other book, and this is a good book for anyone that basically wants to understand direct stock investing, but also index fund investing and why that's probably more powerful. This one right here, this is Traction. This is my favorite business book for business owners, for tradies, for managers even. You don't have to run your own business. In fact, I would highly recommend it for anyone that's a manager at work or wants to be a manager. This is a fantastic book because it talks about kind of all the dimensions of running a business, like finding the right people, setting job descriptions, how you can think about setting goals as a team and all this type of stuff. It's a great book, written by Gino Wickman out of the United States. And finally, another Aussie book, Black Belt. So I read this in probably 4 or 5 hours. This book here, it's a really easy read. So when I say 4 or 5 hours, it's 180 pages, but it's not that difficult to read, and it's mainly for business owners and for people who are interested in running businesses or managers. But it's especially probably the type of book that you want to pick up if you're thinking about people and leadership, more so than like a practical guide. If I was to pick, I would say this one's the most practical for the most people, whereas this one, written by Joseph Healy and David Hornery, who I've I've interviewed both of them. They're the founders of Judo Bank, which is on the ASX, for those of you that are familiar. So if you are streaming this live, you're from, okay, someone's coming from the Pilbara, or is it Pilbara? I've never really understood that. Thanks, Luke. You could be hearing this from the Rask Australia YouTube channel. You could be watching it on LinkedIn. You could be watching it on Selfwealth YouTube channel. You could be watching it on the Australian Shareholders Association YouTube channel. So wherever you're joining us from on the ether, thank you. And wherever you're joining me from in person, thank you very much. So tonight, NBN Zali says, joining us from North Korea. I've got a thinking feeling that that's probably not possible, but who knows? If you are joining us from there, thank you. Okay, Bosang, you've said hello, Owen. I am Bosang from Jakarta, Indonesia. Well, welcome from Jakarta, Indonesia, not far, just across the water here. So I'm over in Denpasar, Canggu to be precise, actually, and it's really balmy and warm here, which I'm loving. I was holding the books upside down. Oh, sorry about that. Okay, so tonight we're going to be covering valuation. So I do have a few slides, and I'm hoping that it all comes through loud and clear. We are going to cover two companies as part of this. We're going to cover Xero, the software business, which does accounting software. It's a wonderful business. Full disclosure straight at the outset, I do own shares of Xero. The other business that we're going to cover is Lovisa. So we've talked about this on the show before when we were running Selfwealth Live. So over on the Selfwealth YouTube channel, I'd highly encourage you to go back and look at the discussion I had with Gaurav Sodhi, and we all asked questions of Gaurav from Intelligent Investor. So for those of you that don't know, Lovisa is a place where you can go and buy jewelry just like this shown on the screen here. Now, so like trinkets, lockets, necklaces, earrings, these types of things. And typically, I would guess that most things are under $40 Australian. Perhaps you could probably get a few things more than that, but it's the kind of place where you go and you might get 3 sets of earrings for $10 or something like that. So it's like fast fashion, but in a way that they hope is like to market and you can reuse it and do all that sort of stuff. Whereas Xero's just selling a subscription. So if you do have any questions, please chuck them in the chat. I'm just going to roll. You've all heard the disclaimer at the top of the show, but just because we're going to talk about a few companies, you will see a banner below the video here that just as a reminder, any of the information that you do here is limited to general financial information only. Okay, so if you haven't already subscribed, please make my day by subscribing. No matter where you are, if you're watching this on Twitter or X, as it's known now, no matter where you are, please hit the subscribe button because I do really appreciate it. And it means that you get a notification every week when we go live. I was actually having a look just a moment ago, and we on Rask YouTube channel, we've now published over 1,000 videos, which is just incredible. Yet we only have around about 20,000 subscribers. So I'm hoping we can bump that up to 50 or 100,000 in the next year or so. So please have a look. Luke, you've said Pilbara for pronunciation with a winky face. And Luke, I'm not sure if you're familiar with this, but over on Selfwealth, the team from WA did a very good job of correcting me many times by saying it's not pronounced Pilbara, you Victorian. So that's something that Victorians probably get wrong often. Okay, here's the joke of the week. Dad, I'm cold, says the son. The dad says, go stand in the corner. I heard it's 90 degrees. So if you get the joke, you probably do if you're from Australia or you're thinking about degrees Celsius or these types of things. But go stand in the corner. It's 90 degrees. That's the joke for this week. How did I do out of 10? Let me know. It's a bit hot over here, so maybe I'm not performing at my best, but thank you if you do give me a score over 5. Okay, so this month we are covering a lot on Rask Live, whether we go live at 6 p.m. Wednesdays or midday. We are going to be covering a lot over the next 4 weeks. Tonight we're obviously covering value shares. In next week, I think it is, or the week after, 7 stocks for retirement with Dr. Andrew Dermuth. Just kidding, his name's actually Drew Meredith, but that's the fun name that we give him when he's on air. Then we'll have a property update. So we'll be talking about how property buyers, property upgraders, people that are even sequencing into retirement, how you can think about property and Australian property for that. That's with Chris Bates. Chris Bates is the number one mortgage broker in Australia of around 15 or 16,000 as voted by the advisor a couple of months ago. So it'll be a real treat to have Chris on. And finally, we'll do a bit of a macro update. I'm hopeful that we'll have the likes of, I think it was Shane who sent through an email to me because there was a while ago, a company called ProMedicus. Rest assured, we're going to have Dr. Sam Hupp on the show. He's the co-founder and CEO of ProMedicus, Australia's best performing company. So tonight we're how to value stocks. The way I was hoping to put this together, it's a pretty ambitious in 1 hour, but basically I was hoping to put it together is to start as easy as we can and then move on up into the real examples and get more complicated. And I think if you find this conversation a little bit hard to understand at first, that's okay. I'd encourage you to go back and listen to it. But what's really important is that I guess you don't give up. If you do want to understand why valuation is important and how to do it, I think many books that are written on the topic. We've also got a free course at Rask. So this is not let you know. We've got a paid version, and a lot of people think that there's only the paid version. This is easily the best course we've done, but there's another one which is free. This intermediate one, this is free, and it uses the Australian supermarket business, Woolworths, as the case study. And I did it about 5 years ago, maybe 6 years ago. Tens of thousands of people have either taken the course here or on YouTube. Both are free, so you can just go and enroll in it, and you get all the templates and everything for you. So just Google Rask valuation course. It's called The Value of Everything. It's also available on YouTube. It's free. So if that's the sale for tonight, that's the one. I'm not here to sell you anything though. I hope that makes sense. So Karen, you said to subscribe today, but didn't get a notification. That's a bit frustrating. Oh, Karen, the reason why anyone didn't get a notification for today is because I actually made a mistake with the time zones. So the streaming software automatically set it to 3 p.m., not 6 p.m., because I'm a few hours behind. Stuart's given me a 9 out of 10 for the joke. Thanks, Stu. That is actually pretty generous. Okay, so how to value stocks. So value investing is this thing that's been Buffett in. There were many before him, but this is him and put it in the limelight after following in the footsteps of Benjamin Graham. The stock market has been in existence for hundreds of years, and people have been applying some type of valuation style to it. And I'll explain what I mean by that in a minute. But the reality is, while the idea of value investing makes sense, like when people are like, oh, $1 for 50 cents, I'd love to buy $1 for 50 cents. The reality is that it's not easy to actually implement. And that's why a lot of people, I would say 99% of people in the stock market will talk about it as if they know it, but they don't. Even people on television, a lot of the people on television, I dare say, would not understand it. And frankly, maybe not 99%, but a lot of people don't actually understand it. And so it's very easy to get misguided information about what it actually is, its limitations, Okay, now we are going to see if we are back. Are we back? Are we back? Are we back? I hope we are back. I think I've just come back and we're back. Harry says, fantastic. I think I just come back and I saw the quote. I saw another quote, the comment that says, "My wife might have pulled the plug to help me relax." Well, the thing is that here even on holidays, all I can think about is business. I was out for lunch yesterday, just at a local cafe here in Canggu, and I was asking the business owner all about the business and how they've grown the business and how it survived during COVID. And so, yeah, all good. I think we could be back. We'll just touch and go. We'll see how we go for the remainder. I'm hoping that we can do this session because this is probably the thing that I'm most passionate about outside of just educating people generally on investing, as you know. So I was saying before I was rudely interrupted by this internet connection, that basically if you want to learn to invest in individual companies, you should have an understanding of value investing. But if you're an ETF investor, you probably don't need to understand it as much as the next person. And I think the finance industry does a very good job of confusing us into thinking that we need to know things we simply do not know. Like, how many times have you clicked on a news snippet or tuned in for on the tally and someone says the stock market's gone up today because of the Federal Reserve? No one actually, I don't think anyone who knows what's going on actually believes that. I don't actually think that people that are direct stock market investors think the day-to-day movements of the stock market are in any way rationalized by a simple metric. But in order to make people feel at ease, they put something on the news. And then the more dangerous kind of people that work in finance are the people who pretend they know what's going on when they don't actually know, and they're just there to fill the space. And so you don't actually need to know all of this stuff if you are not interested in direct investing. And by that I mean, if you buy individual companies, like private businesses, like if you run your own business, this is a really good thing to understand, because if you're going to sell your business, you would want to know what other investors are going to look for that are actually informed. So I think value investing and the concepts that have been popularized by Warren Buffett and others like him is that value investing is more about avoiding losers than it is about hitting home runs. So the process of going through the valuation actually helps you avoid some really bad outcomes. I would say I'm going to share with you my spreadsheets, and you'll be able to see all of it in a moment. Now, I won't actually share the spreadsheet with you because that's something that our students pay us for, but you can just take a screenshot and you can see how it all looks, and there's the free version that's available on the Rask website. But in any case, 95% of what I do when I look at individual companies to buy is not here in a spreadsheet. I want to be very clear about that. Most of the stuff that you do, even as a professional investor, or in my case, a professional analyst, most of the stuff that we do is not here in the spreadsheet. It's talking to people in the industry, it's putting notes down, reading annual reports, finding out what's happening in the industry, who are the competitors, what are their strengths, where are they going, what's their view on certain things. And so for the most part, a lot of what we do here is the end result of all of our work, not the start. And I think that's where people tend to get things wrong, is they tend to go into investing in companies and value investing and thinking, I need to kind of just jump straight into the spreadsheet. And I'll say why that's wrong in just a moment. But maybe I wanted to put this bit in here just to clear this up. A lot of people say things in investing like value stock, or like it's a cheap stock, or it's a good value stock, and it's a growth stock. At the end of the day, none of those things actually mean anything. So what I mean by that is every company is an individual company. And the reason why we say it's a value stock is because we say, statistically speaking, it looks cheap. It doesn't mean it's actually cheap, and I'll explain why in a minute. So when people say it's a value stock, they're looking at statistical measures of value. But when I talk about valuation, I'm talking about both the art and the science of it, like going into the industry and hearing what people have to say. And I want to give you a really good example that I often give with students, which is that when you're individual investor in shares or businesses. What you're actually doing is you're trying to determine, is that business going to be worth more in the future? Will it make money in the future? That's what you're trying to do. And I'll give you the best example of this. I want you to imagine your local cafe, restaurant, wherever, the most common place that you frequent, even if it's a supermarket, just wherever, let's just say it's got food involved or it's got drink involved, wherever that is, I want you to imagine you're there right now. And I want you to imagine looking around that supermarket or looking around that cafe or looking around that restaurant and just thinking to yourself, if I was to buy this, what would I consider? Like, what would I take into account of whether it's a good business? You'd probably take into account how many staff are there? Are staff happy? Are the products expensive? Is there a competitor right next door? Is this a really good location for this business? Do I think this business is growing or declining? All of these things are what a business person would think about. Yet what the industry, the finance industry, tells us to think about are statistics, rather. When for the most part, it's actually the business that matters most, not all of those numbers. And let me just flesh that out a bit more. So I've actually got a note down the bottom here that when I look at a business and its valuation, the way I look at it is pretty simple. I look at the products, I look at the services that it provides, I look at the people that run it, the industry, and then I look at the financials. Now, that's very different to what many of us probably think when we think about investing. We think about financial statements. We think it's pretty overwhelming. But the reality is, if something's a good business, it's much more likely that you'll have a good outcome by buying a good business and overpaying for it than buying a really bad business for a cheap price. And I think some of the worst words in investing ever created were buy low, sell high. And we've covered this on the show a couple of weeks ago. But the reason why I say that is because when you think of buy low, sell high, what you're actually thinking is well, I've got to find the cheapest stocks. And now go back to your cafe or your restaurant, your supermarket example that you've got in your mind. You're probably not thinking, well, I'll just go to the cheapest supermarket, because it's probably horrible and it's probably going to go out of business. And you're probably not thinking, well, which one is most likely to offer me the lowest value coffee? Because if it's really crap coffee, you're probably not going to drink there very often. And so that's kind of a misguided belief that our industry has, is that you've got to find the cheapest thing, because it's not exactly true. And the way that you can think about valuation, finally, as I just wrap this up here, is imagine you're walking into a shop today. You're going to buy a new pair of Nike shoes. If you see Nike on the shelf and it says $250, I've never paid $250 for Nike shoes. So to me, it's already overpriced. But you might think, well, I think those Nikes are worth $500, or I think those Nikes are worth $300. So in your mind, you think it's good value. I think it's overvalued. And this is another thing that we see in the stock market, is people think that there is one value and it is scientifically proven, when it's not. Because the industries and the people that run these businesses are forever changing. And so the valuations must also. And you can check that by going into whatever place you get your analyst information. So it's published here in Ticker. It's also published inside Selfwealth. And you will find that there are 20 different analysts covering most of the big stocks, and they all have different valuations. They might be all in a general cluster of valuations, but they're kind of all over the place. So it proves that it's like parenting. Like, there's no one book on parenting. There's a whole range of books, because there's so many different styles of putting a diaper on a child, or putting a nappy on them if I'm in Australia. And so at the end of the day, valuation is much the same. Okay, so let's get into some kind of the meat and potatoes of this. So valuation is just trying to estimate when your money will be returned in the future, and how much you're going to get. So if you invest $10 today, that might be the share price. That's what you have to pay for the shares, $10. But you expect it to go to $20 in 5 years. It means that in the future, you expect more money in return. And so that is investing, right? As opposed to speculation. In speculation, what we have is people just guessing. So there's no estimate wrapped around that. They just go $10 now, $20 in the future. Yeah, maybe. Or they go $10 now. Who knows what it's worth, but I think it's going up. That's kind of speculation. Valuation is putting some numbers behind that and having some research to fuel that. And this is the key thing. Valuation comes after you do your research, not before. So if you go into, say you go into Selfwealth or you go into your ticket terminal and you see Lovisa's share price is $18 and you think buy, there's no real science gone into it. There's no research. And the only thing that can fuel your research, that fuel your valuation, is a bit of research. This spreadsheet here took me about half an hour to put together, and I'll explain it in just a moment and how you can get a valuation from this. So it took me about half an hour, right? Normally I would spend about 1 to 2 months, but it was a quick and dirty version. Okay. So final thing before we get onto the tools that you can use to value these two companies. So one of the things that people get wrong in investing is they often think that there's only one way to value things, which I've already mentioned, and then they only use one tool to value them. Imagine if you are building a house and I said you can only pick one tool. You've got to pick a hammer, you got to pick a drill, you got to pick a saw, and that's it. You got to pick one of those and that's it. The reality is that's not right. You could use all of the tools. In fact, you probably should try all of the tools, but you also need to know which tool is right for which job. And it's just like investing. We need to know when we have a certain company at a certain point in time, what's the right valuation method for that. So imagine this company here, imagine this line here. So I hope you can see this in front of me. Here we can see that there are kind of different stages of a business's growth. So the green line plots its sales or its revenue, and the blue line plots its profit. Profit is just called earnings overseas. So if you're in the United States watching this, we call them profits, you call them earnings. Same thing. Okay. So if anyone is game enough to comment live, where do you think the companies that we're talking about tonight would sit on this scale? So for example, we've got Lovisa and we've got Xero. Both are typically considered faster growing companies. So which part of this would they sit in? Would they be in the R&D phase, the research and development? Would they be in the launch phase? Would they be in hypergrowth? Would they be in maturity phase? Or would they be in decline? And you can see the numbers are illustrative of where a business might sit. So just chuck it in the chat now where you think this would go. And I can see Will and Gabba, you've said resolution is much better, so you got better bandwidth. Yeah, I just went with my hotspot as opposed to the Wi-Fi from the hotel here. I was going to go to a co-working space here in Bali. There's heaps of different co-working spaces around, but they're just they're not the private offices. So Raya, you've said you think that Xero and Lovisa would be somewhere around here. So you think they would be in this phase here, somewhere where their revenue is going up and their profits are going up. Macro notes, you're saying Xero is in here at mature. Karen, you're saying hypergrowth as well. Gary, you're saying in maturity. Okay. Virtuoso. Oh, good to have you back, Virtuoso. So you're saying Xero is in the early parts of 4. That's where you're saying Xero is. And you're saying Lovisa is in 3 at hypergrowth. Okay. So we can all kind of agree, Mr. Vetpal, you're saying the same thing. So we can all kind of agree that the two companies that we're talking about today are probably somewhere in this phase, right? Probably somewhere in here, maybe Xero's up the end here. So Xero's up here and Lovisa's probably more down here. It's kind of fair that we're all in this phase here. Now, a venture capitalist, like the people that invest in really small businesses, they're operating down here. And so at this stage of a company's growth, the valuation tools that you want to use are definitely not the type of tools that we want to use when we're talking about the other two companies today. The most common company valuation metric for professional analysts is something called a DCF. I'm going to try and write this. DCF, and I've got it in just a moment. I've got a new mouse. Some of you will remember I was in Sydney last week and I had a different mouse. So DCF. And a DCF stands for discounted cash flow. Now, you would use a discounted cash flow probably somewhere from about here till about here. Maybe you could argue a little bit further either side, but this is when you would use a discounted cash flow analysis. So a discounted cash flow analysis, as the name suggests, is a valuation tool that basically tries to estimate the cash flow inside of a business. Okay, so a Peruvian in Melbourne, Rodrigo, how are you going? Okay, so I'm going to use an example here, and I'm hoping that my internet holds up. And I'm going to grab a tissue box here, a wooden tissue box, because of course we're in Bali. So over here we have a tissue box. Now this tissue box, if I obviously pull a tissue out, and I will try and grab one here, I can see there's tissues inside, right? So I want you to imagine that this is the tissue box. Now, normally what would happen is at the beginning of the day, someone would come along and put tissues inside this box. And then throughout the day, people would pull tissues out, right? Pretty simple. Imagine that the tissues are cash going into the business, and when I get a dividend, that's cash coming out, or when the business makes more of a profit, it kind of stays inside and it gets bigger and bigger and bigger. And over time, you would hope that the box gets bigger, even if it pays out dividends. That's basically what we're trying to estimate with a discounted cash flow analysis. We're trying to estimate how much tissues are inside this, or how much cash is inside this, and will that cash grow over time so that it gets to a point where the cash flow inside the business is bigger and bigger and bigger, and it can be paid out as dividends. So we're trying to value the box. Now, it sounds very simple to put it that way, but what we have to do is we have to work out, well, is there going to be more tissues in the future? Is it growing? Which stage of the cycle is it in? When you're very early in the company's journey, like down here, this would be like there are no tissues in the box yet. We haven't even built the box. So we can't use a discounted cash flow analysis because there is no box yet. It's just an idea down here. It's like a big question mark. We're just, okay, maybe it happens. Now, another thing but there are some tools you could use. You could say, well, if this works, then it might be this big. Like, okay, we're going to start the next Amazon. Okay, well, Amazon's $1 trillion company, so maybe it can get that big, but obviously the probability is very low. Okay, so when the company is kind of new, it's in this phase here. It's actually really hard to value with a DCF or a discounted cash flow because we still don't know how much cash it's capable of generating. That's why it's not at break even yet. You can see that here with the blue line. But as a company gets bigger and bigger and bigger, its revenue, its sales, its cash flow becomes more predictable. We know that we can pull a few tissues out every day and it will be fine still. But let's now imagine a different valuation tool. Let's say, how do we value these companies down here when maybe it's still early? This is where we can use something called multiples or ratios. So some of you or all of you probably have heard something like the PE ratio. So you can use this, and I'll explain how to use this in a minute, when a company is probably from, let's say, this point right through to this point. In this method, what we're doing is we're just comparing the share price, P, to the profit that a company earns. Sounds pretty simple. And you can see that I put it right here because down here is where break even is, right? If it's got no E or profit, if it's got no earnings, you can't use the multiple. You can't use this tool, right? It's a really simple idea, but people still try and say, well, the company's not profitable, therefore you can't value it. You can, you just have to use a different tool, and I'll explain why in just a moment. Another thing that you can use is you can use something called the price to sales ratio. So this is the same thing where we're comparing the share price, P, to the sales of that company. So it's literally just how much is the share price and how much sales does it produce per share. And we can use this from the moment it has sales. So in this case, we can see that it's got sales down here or revenue. So we can use this multiple from here right through to the end. Now, I'll explain why that's not great in just a moment. But if you probably think I'm crazy, right? But when you have private businesses like cafes or like you have restaurants, this is the most common way to value a business. This is the most common way because it's simple and people can understand it. Well, if it made $1 million of sale last year, the industry standard is that I would pay 1 times that. So I will give you $1 million valuation. Pretty simple. It's not that clear cut in the stock market, but that's how it does. That's how it happens in the real world. Okay. So let's focus on the most common one, which is this one right here, the PE ratio. So I'll be really quick. So this is just called a multiple because we're just comparing 2 different things and we're trying to figure out how many multiples of it is. It's also called a ratio, just to make it even more confusing. We call it the PE ratio because it's also a ratio. So ratio, multiple, same thing. It simply compares the share price to the earnings. And what are earnings? Earnings are just profit. In the USA, they say earnings. We say profit in Australia. So, for example, a PE ratio of 30 would mean the current share price is 30 times as much as the yearly profit. So you've got a company and you say the PE ratio is 30. What that means is if you buy the shares today, you're prepared to pay the equivalent of 30 times the profit that the company produces in 1 year. And you're probably thinking that's pretty high anyway, but a PE ratio of 10 would mean you're paying 10 times the yearly profit. And most people get this information, and what do they think? They think, well, 10 is better value than 30. And yes, that could be true. So you're paying less in yearly profit. So this would be like the cafe makes $100,000 profit a year. I'm going to give you $500,000. That's 5 times. And then the next person comes along and says, the cafe makes $100,000 a year. I'll give you $1 million. That's 10 times. Now, obviously, if you could buy it for 5 times, that would be better than buying it for 10 times because you save money. It's half as much. But this is where people go wrong with this. When people think about the price earnings ratio, they only think about it in terms of the ratio itself, like 20 times, 30 times, etc. If we go into Google really quickly and we look at Lovisa, we can see that it has a PE ratio of 31. Okay, so very close to that. Most people see that and they say that's expensive because they'll compare it to another similar-ish business, which is another retail business called JB Hi-Fi. And they'll say JB Hi-Fi is at 10 times PE ratio and Lovisa is at 30 times. Therefore, JB Hi-Fi is better. So I would love to get your opinion on this. So for those of you that don't know JB Hi-Fi, most of you will. JB Hi-Fi is the Australian electronics retail business. So I think it's the biggest electronics retailer in Australia. It sells TVs, Apple Macs. That's where I bought this Mac that I'm recording on right now, and that type of thing. So it's similar in that it sells things in a store, just like Lovisa. But can you all tell me, where do you think JB Hi-Fi sits on this chart right here? So remember I'll bring this to the front. Where do you think it sits on this chart? So this revenue and profits chart, which stage of growth is it in, basically, is what my question is. And I'll get rid of this so it makes it a bit clearer for everyone to understand. Which part of this chart, 1, 2, 3, 4, 5, does JB Hi-Fi sit? So if you just chuck that in the chat, so Rad's saying 4, it's in maturity. Oh, I'll get rid of that. That one. Okay, so I'm going to plot these on this chart in just a moment once you've all put your guesses in. There. Between maturity and declining, says Ryan. That's a bold one. Okay, so, early stage 4, says Paul. Okay, 4, says Rajan. Crisp says 4. Okay, so it's clear that most of you are saying 4. So you're saying JB Hi-Fi is up here. We are saying Xero is here. And we are saying Lovisa is here. So in a sense, what we're saying is we think JB Hi-Fi is a mature business. So maybe because it's in number 4, we use a different set of tools to value that business. And that would be the correct answer, is that we would use a slightly different method. Or if we were trying to compare JB Hi-Fi to Lovisa, if we're trying to compare those two, we would have to understand that one looks like it's still growing and the other one is still growing, but maybe not as fast, and maybe it's reached this kind of flat point. So Will and Gabbo, you've said maybe even the start of 5. Okay, so we can see this. We can actually see the profits and the direction that is going very quickly of a company. If we go into any type, and you can do this inside Selfwealth. I won't attempt it because my internet's a bit slow. But what we can see here is we can see the profits per share of Lovisa. So this is showing you how much profit it makes for each individual share. And you can see it's pretty lumpy, but for the most part, it goes bottom left all the way up to the top right. So it's kind of in this fast growth phase. So you've got a clue that it's in this fast growth phase because we can see the profit here and we can see the actual profit that it's reported by just jumping into one of these data banks here. So we can see the profit is on an upwards trend. So it would make sense that it's at that phase. And you can do the same thing. It doesn't have to be profits. You can just look at the revenue to see which way it's going. And if we did the same thing for JB Hi-Fi, what we would see is it's also growing, but it's not growing as fast. So that's the key insight. So I would say all of you have got, in my opinion, it's only my opinion, would say we're all on the same track here. We're all kind of generally correct. Will and Gabba, you did ask a question before. You asked a question between, is the spread between analyst estimates useful? So typically, just quickly, what you'll see is if we imagine the share price is here today, so we can see the share price over time for JB Hi-Fi. The share price is here at $46.82. Analysts will put different projections out into the future, and they'll say, I think it's worth $48. I think it's worth $50. I think it's worth X, Y, Z. And you're saying, if all of the analysts kind of agree it's in a general direction, does that mean it's a good thing? And what you tend to find, to answer your question, Will and Gabba, is that you tend to find analysts get better at forecasting a business when it is here, right? This is when a company is easiest to value because it is in a mature phase. And by the way, from here to here, this period could be 20 or 30 years. To put this graph isn't to scale. This could be 20 or 30 years. So in that time, that's the easiest time to value a company. But that's why you also don't get the best valuations at that point, because everyone kind of knows what JB Hi-Fi is going to do. But when it comes to Lovisa, which is earlier growth, it's a little bit more uncertain. And that's where you get most professional investors trying to find companies in this phase, because they know that that's where it's hardest to do their valuations. So I hope that roundabout way answers your question, Warren Gabba, that if the valuations are all really close, I'd actually probably be a bit more concerned than anything, because I'm probably fishing in the wrong pond. Okay, so let's continue on. So the thing that people get wrong with their valuations is they forget that it's not just the ratio that matters, it's how fast each of the individual things can change. No one can control what the P is, the share price, but the company, to some extent, can control what the E is. The E is the earnings or the profit. And so let's just take an example. Let's say you have a share price today of $20. The profit today is $2. If you took $20 share price, P, and you divided it by the E, which is $2, you've got a PE ratio of 10. Now, if we go forward 5 years and we've got a profit per share of $5, so we've got $5 in profit, not $2 anymore, now the PE ratio is 4. And then if we go 10 years into the future and we go, it's now $10 in E or earnings, now the PE ratio of 2. The bottom line is, if you just use the PE ratio, you could be missing out on the fast-growing companies. So you have to be really mindful of that when you use this tool. And that is definitely one of the shortcomings. Okay, one more thing, because we're going to use an example of both of those things, both of these tools, in just a moment on these companies. Okay, so with the discounted cash flow, this is much more technical, and I'll show you what this looks like in just a moment. It is the most powerful because it requires you to do the most work in the actual modeling, and that can help you identify weaknesses in the company. But basically, the way a discounted cash flow analysis works is we just take this tissue box that I've got over here off to the side, and we're trying to work out how many tissues will be in that in the future, and then figure out if that's a good price to pay. So we have this thing, a box, it's called a company. The company can reinvest back into itself. So instead of taking tissues out, it stays inside and it just keeps getting bigger and bigger and bigger and bigger until eventually it's a really valuable tissue box. There's heaps more tissues inside, and all of a sudden we've got a more valuable company. The problem with a discounted cash flow analysis is people can get it really wrong, because if they make one mistake, as the saying goes, just like the Hubble telescope, they're looking in a different galaxy. It's like if you have a telescope at home and you're looking at Jupiter in the sky. I know this because this is what I do, because I'm a bit of a geek too. And I look up into the sky and I see Jupiter. If I make one little mistake with that telescope, all of a sudden I'm looking in completely the wrong galaxy. Like, I am way past Jupiter and I've made a huge mistake. And so the reality is that you have to be very careful with these tools, and I'll explain that in just a moment. So let's jump into what these two things might look like. Let's go to Lovisa. So Lovisa is, as we know, a company that sells jewelry. It sells jewelry at like little fashionable items at an affordable price. And so I put this together in about half an hour today. Now, hopefully you can see, you may need to zoom in a bit, and I maybe zoom in a bit myself. But all of this information just comes from the company's 3 annual reports that I've got right here. So the first thing that I wanted to find, and I just press Command F on my Mac, the number of stores that they have, and they break it down by where the stores are, so all around the world, and they do that consistently, so I can use that information in my modeling. And then I also looked at something called the profit and loss statement, or the statement of comprehensive income, which is right here. And so what I'm looking at is I'm looking at the profitability of Lovisa. So at the top, we have the revenue or the sales that the company generates for itself. Like this is the Lovisa overall of all the stores. This is for Lovisa. And then I looked at the profit way down the bottom here. So you can see I've got the revenue up the top and I've got the profit down the bottom. So all I did is I just put that in my spreadsheet, just here, very simple. Like I put it in the years. And then I've got the number of stores. I just got that. You saw before. I just got that from the annual report. And then I just divided the revenue by the number of stores to work out how much revenue they make per store. Pretty simple, right? Like pretty straightforward. So here we can see that a Lovisa store in 2019 made about $641,000. So on average, a Lovisa stores make $641,000 in sales or revenue, same thing. Now, if we go across to the COVID year, this is obviously when it was very difficult to operate some of these stores around the world. Not all of the stores were closed, but in parts of the world, we can see that the sales dropped per store because people weren't in shopping centers. So they couldn't go to the store as easily. And we can see that it's recovered drastically. It's done very well in the past 2 years. Now what we can do is we can actually even look further down and we can start to compare things like EBIT, which is just a different measure of profit, or we can look at NPAT, which is just a different measure of profit. So where is that? So this is profit after tax. That's where I got that figure from. And EBIT is this one right here. This is sometimes called EBIT. I won't bore you to death with what that means. But we can see here that at the end of the day, the company makes, I'm going to use this figure for profit per store because it excludes tax. We can see before tax, a Lovisa store makes about $130,000 of profit. So every Lovisa store that you walk past in a shopping center is about $130,000 a year. Not a lot of money, but when you've got a lot of them around the world producing more and more as time goes on, eventually that becomes really, really powerful. And so what we can see is that over time, other than during the COVID period, it's been pretty consistent. So I could forecast that out into the future. And I could say something like this, and I'll just go like this. So 130,000 for each of the few years into the future. We can see that the revenue per store is slowly increasing. So what I've done in my forecast just here is I've slowly increased them. All right. So now that I've identified the pattern here, and I've identified the pattern here, I'm pretty confident with these two. And I can see the number of stores are slowly increasing every year. So 45 that year, 109 when they made some acquisitions, and then another big acquisition here got them more stores. But you can see it's generally consistent. So I'm just going to be conservative and say they're adding 80 stores a year. This is just something I plugged in. So now that we know the revenue per store, we know the profit per store, we can effectively say, well, we know how many stores they're going to be in the future. We can now predict what the revenue and sales are going to be back up here. So it's just this times this equals this. So you see how we went down this side and we went back up that side using what we know. That's basically what we're doing. But if we just cut down to the bottom here, what we can see is we can see that the profit per share. Remember that thing, the E? And we can see down here that we've got the profit per share. In the year 2022, it was 54 cents. The year after that, it was 62 cents. And I just calculated that by taking the profit and dividing it by the number of shares. So if you think about it, the number of shares is pretty simple. You can just find that in the annual report. Take the profit that it makes that year, and then you've got the profit per share. Number of shares, amount of profit, profit per share. So we can see that here. And that's the same thing that we saw right here. Right? So my numbers match their numbers, which is great. It doesn't always happen that way. And so we can use this information to forecast out into the future as well. So we can say, well, we think it's going to make this much profit in the future, this much profit per share. So, okay. Now, I've probably bored you to death with some of the stuff, but I'm going to be really quick here. What we can now do is if we've got the share price, E, and we've got the profit per share, we can now calculate the PE ratio. And all that means is we can take this number and divide it by, say, this number. Let's do it. This divided by this. Price earnings ratio of 30.85. Let's go back. Price earnings ratio of 30.85. There it is. It's exactly the same, right? It's exactly the same thing. Now we know that we've made some forecasts into the future of how much profit they might make per store, after tax even, how much profit they might make per store. I've done another forecast here. So now we can calculate how much they're going to make in earnings per share, or the E. So we can say, okay, the price earnings ratio today is 30.85. But how about if we go further into the future? So say we go in this year, we want to calculate this here divided by this. Let's just do that. This divided by this. Then we go this divided by this. And we go this divided by this. So if we were to buy the shares today, effectively what we're saying is we're paying 31 times today, but it's only going to be 27 times next year's profit. And it's going to be 26 times or 27 times the year after that's profit. And so we can see how we can all of a sudden see the E explaining what happens in this valuation. So if we go back to our chart, I don't want to get too bogged down in the weeds, but what we can see is the profits are growing. So even though we pay a higher price today, we can see the E is growing. And you can see that we've been conservative. So let's jack it up a bit. Let's say they open 150 stores each of the next 3 years. And let's say that their sales per store climbs quicker than what we thought. So say to 820,000. And we can see that their profit per share, which I've got down the bottom here, is actually a lot higher because I just did the average. Let's say it's $90,000 for the next year, 95 the year after that, and then 100 in the year after that. Now we can see the price earnings ratio that we would be paying today would be 18 times the profit in 2026. Now, this is assuming that our forecasts are correct, which it's very hard to do. But you can see how all of a sudden this valuation metric starts to make sense and why just focusing on one number doesn't make a lot of sense. So anyone can do this. And please, if you want this spreadsheet, I should be able to just create one of these in the next couple of days and put it in the comments afterwards. So please let me know if you do want a copy of this spreadsheet here in particular. So this is basically how I use a PE ratio. And I basically say at the end of the day, I compare the PE ratio and I look at it and I compare it to what the industry might be. So what are the other companies in the industry that are at a similar phase of growth? And do I think that's good value? A lot of professional investors actually use this method. They go, if the PE ratio for Lovisa is 31 and the industry overall is 25, maybe it's worth paying a little bit more than the industry average because it's a faster growing business. And that's how you can make a more educated decision. So Vivian, I can see that you've just said, yes, please, you would like it. So I'll make this spreadsheet available to folks as well as the other one that I'm about to talk about. I actually forgot to mention something, but when I do this valuation, remember I said this only took me half an hour. I wouldn't make an investment decision based on this. So obviously, strictly general information only. And this is just a very quick thing. What did you do on your holiday? Owen, I made a spreadsheet. Yeah, that should be my dad joke. I made a spreadsheet. So this is very just a quick and rough estimate of how you can think about it. But a little while ago, you might remember that we went through my checklist for investing. So I'll include this one here too, and I'll put this up in the next couple of days. So just give me a couple of days, guys. And you will remember that I ran Lovisa through a checklist. And you can see that checklist here. And if I go a little bit left, you can see all of the things that I look for in a company like Lovisa. And then I gave it a score. And at the bottom, we gave it an overall score. So you would use this in combination with a quick valuation like this to give you a sense of what's actually going on. And you would keep updating this, and you do this for more than one company. But you can see how this comes together. So we've got the checklist here, does not take into account valuation. Then we've got a quick valuation here, and this would be done towards the end once we've done our research. So I can share both of those with you. Now, let's take a bit of a step up for the last, say, 5 minutes. And I don't want to, many of you that come in tonight are really interested in this stuff. A lot of investors aren't. They don't go to this level. So be fully warned about what we're about to talk about. But by far, the most prominent method of valuing a company in the industry of investing is this thing called a discounted cash flow analysis. Now, this is where things get a little bit more technical, because basically in this, we've got to forecast the financials of a business. And the way we do that is in a few different parts. So the first part that we have to do is we basically have to work out what drives a business. So in this instance, this is for Xero, which sells software. It's like $60, $70 a month for a business to get this software. And they've got millions of subscribers around the world. So if you multiply millions of subscribers by $60 a month, by 12 months in a year, that's how you figure out how much money the business can make. So we can see the subscribers that are growing over time. And once again, this just comes straight from their annual reports. You can go and look this up yourself. And we can see the total subscribers down here. One thing that I've done is I've calculated the growth rates, but I've also estimated how many businesses there are that could possibly use Xero's software. Because you can go into like the government databases for the number of small businesses in the USA, the number of small businesses in Australia, the number of small businesses in Canada, the number of small businesses in the UK, Indonesia, France, wherever you're looking, you can find government information. It's pretty reliable. So here we can see that for the most part, you can see my rough estimates, and some of them are very wrong, by the way. And you can see that I've assumed that the Xero captures a pretty big slice of the market. And so you can forecast all of those individual things out into the future. So you can forecast how many subscribers you think they are going to get based on the growth. You can forecast how big the market you think it's going to be, and so on and so forth. All of this stuff here just comes straight from Xero's annual report. You can just get that yourself. And then what your job is as an individual investor is to forecast those individual things out into the future. So we know how many customers there are up here, right, in the market. And we know how much they make per customer. So you can see here, we've got the revenue per user. That's just $29 a month. You can see on average, this is on average, right? So you can see that's per month. And then we can go down and we can begin the income statement. So we've got revenue at the top, just like for Lovisa. Where was that? You will remember in the Lovisa one, we have revenue, and we started at revenue. But basically what we could have done is we could have started with the number of stores. So Lovisa's got stores. Xero has subscribers. That's the only real difference. So if you just estimated the number of subscribers multiplied by how much they pay, you get the same output. I just put a bit more complicated stuff in here. And then what we can do is we can just take whatever Xero gives us as on their profit and loss statement, and we can just forecast each of those things. So how much do they spend on sales? How much do they spend on research and development? How much do they spend on administrative costs? And so on and so forth. And then we get down, and I won't bore you to death with this right now because you can look it up online, or you can just go and take my free valuation course. And you can see what all of this means. But basically, we take the forecast from the statements and we turn it into free cash flow. And just follow this formula. Once you know the formula, you can follow it. It's just a bit confusing at first to figure out where you get these different parts from in the annual report. But once you've got them in your spreadsheet, you can forecast them out into the future. And finally, right down the bottom here, what we do is we add up all of the cash flow that a business generates, even if it's negative, we add up all of the cash flow, and you can see that in the green section here. We add up all of that cash flow from Xero in the future. We add it all up. We try to put it into today's dollars, and we get a valuation. So here we can see a valuation using discounted cash flow analysis of Xero. This is just the value of all of the cash flow in the future. We take away any debt that it has. We add any cash that it's got in the bank back into our valuation, because that's obviously cash in the bank. It's a good thing. We've got a value of the company. We know how many shares there are, and we can just divide the value of the company divided by the shares outstanding to get to our valuation. It's obviously New Zealand dollars because it's a New Zealand-based company. So we've got to put that into Australian dollars, and we see the valuation here. So I noticed there are a couple of questions in here, but we can see how we get to a valuation. Now, you might be saying, well, Owen, that looks like it's really overvalued. Like the valuation is only $81. but the share price says it's $120. That's because I was doing this in Sydney with a group of students the other day, some great people up in Sydney, and I was just showing them how sensitive these models are. So if I change this one number, let's say I change this one number right here to 8. Does anyone want to have a guess? Does anyone want to have a guess what this final number might be down here, the valuation in Australian dollars, if I change this from 10 to 8? So I'm going to change this number right here from 10 to 8. Have a guess what the valuation will be down here in Australian dollars. Just have a guess. I'll give you a clue. It'll be higher. And if whoever's closest can get a free pass to the Value Investor program, just send me a message on Twitter or Rask on Instagram and say, Owen sent me and I asked the question and here's proof of my YouTube name. Okay, so Ryan said $400 would be the valuation. Ashish said 120. Okay, so Prue says 110. Rob from Selfwealth says $1 million. He could be close. See, Rob's a bit cheeky. He's already got a pass to the Value Investor program, so he knows what's up. Virtuoso, 150, 150. Okay, I'm going to reveal it in 5, 4, 3, 2, 1. Here we go. Okay, let's go up here to 8% and let's see what happens. Now, the valuation is $125.44. So 125 crisp, you guessed $125. So I think you are the closest. Crisp, you are the closest. Ashish, you are very close. Crisp, send me a message on Twitter or Instagram and just include a photo of your YouTube handle, or just send us an email and we'll get you a pass to the course. So I hope that makes sense. And so basically the moral of this story is you can see if we go back to our comments about discounted cash flow analysis, if you move one thing or you get one thing wrong, you can see how sensitive these models are. And they're like the Hubble telescope. But Ryan, you were a bit off. That's okay, mate. So you can see here. Now, the question is, okay, well, what number should you have in here? I can explain that in another week's episode. But basically what this means is this is what return you want from your investment. So if I said 10% in here, I want a 10% return from my investment in Xero, assuming all of my model is correct. I want a 10% return from owning Xero shares. If that's true, then I should want to buy it for $81. I'll have to wait. But if I only want an 8% return, I can pay up to $125 a share, and that is my expected return. Now, this is a lot of complicated maths that go in between that, but that's the basic premise. And remember the old saying, garbage in, garbage out. I think that quote was made for value investing because garbage in your spreadsheet means a garbage outcome. So this is how you create a discounted cash flow analysis for one of the most topical growth companies of the past 10 years in Australia, with another one, which is Lovisa. There was a good question up here from a question from Rajan. A question in this regard: if we are time poor and not able to spend so much time analyzing, are we speculating if we follow advice from services like Morningstar, Rivkin, Intelligent Investor, or I'll add in for you, Rajan, Motley Fool? So let's say you don't have enough time and you subscribe to one of those services. Many of you will know that I use I use Xero, but that I subscribe to Intelligent Investor. I also subscribe to Morningstar. Even as a professional analyst myself, I subscribe to them. And the key thing is this: remember our core and satellite approach. I believe, and it's just my belief, that over the next 10 or 20 years, if we're investors, most of our money, most of our worth and our valuation, our financial wealth creation is going to be caused by the core of our portfolio. So that's where the ETFs, the index funds, the listed investment companies, all that stuff in the core, that is the most important to get right. Then around the outside, the individual companies, like what we're doing tonight, this is a lot more fun. It's a lot more challenging. And that's why we see most newer investors don't focus on this at first and they get their core right, which would be my number one advice. And I would say when you come to picking the stocks around the outside, it makes sense to subscribe to Intelligent Investor, Morningstar, Motley Fool, because you can basically get the ideas from all of these really good analysts who do it full time. And you don't have to invest in everything that they recommend, but you can at least get their research and then use that to build your own research on top of. So I don't think it's a mistake, Rajan. I just think it's important to know the difference between a core and a satellite position. The core is where most of the money is going to be created over the lifetime of, say, myself. And then around the outside, I would use one of those services. But there's a lot of nuance in that debate. Like, do you really feel comfortable owning individual shares? If you don't do the research yourself, you should always do some research, I think, even if it's just understanding or visiting the stores if you're at Lovisa, or using the software or speaking to your accountant if you don't use Xero day to day. Ryan, you said, how do you include impairments into company metrics? Ryan, that's a technical question, and I can answer that really quickly with an example because I've got one right here in front of me. When I forecast a company's financials, I will put down things like impairments or one-off costs, but I will exclude them, but I'll make a note of them. Because if you put those weird charges and accounting things in there, it can throw your model way off. Obviously, if they happen every year, then you've got to account for them in the model. But if it's just like a random once-off here or there, I just make an educated assumption there. I hope that makes sense. Matt, you said you don't subscribe to Motley Fool. Well, Matt, I actually used to work for the Motley Fool. We had Scott Phillips on the show a few weeks ago. So it's not that I don't subscribe to it, but I can say this for sure that I've got some of my friends that help me out with some of those things, and I can chat freely with them. So it's a bit different for me. Okay, so that's about it. That's all I've got for tonight, actually. Ray has asked a good question. How do you determine the terminal value? So I'll just quickly bring this up here. How do you determine the terminal value? So the terminal value, I don't have enough time to go through it tonight, Ray, but basically the terminal value is the value that's created after the final year that you forecast. So it's like all the way out here, right? It's what happens after the year 2033. And there's a value that's created there in our assumptions. You can see that here. So you can see this big valuation here. And basically, the way that's calculated is by setting this thing right here. The terminal growth rate is something that a lot of investors get wrong. So there's a way to go around it. I don't really have it's a bit technical and boring for a lot of folks, but basically, Ray, because you asked, the way you can get around that is you don't have to use this right here. What you can just assume is that in the future, you can just use your multiple. So this is how I do my valuations. I forecast the cash flows out into the future for about 5 to 10 years. You can see that there. But then the terminal value, rather than following what they taught me in academia, because I think that's a bit hopeless, is I don't take this valuation all the time. I actually use a profit multiple or a sales multiple, like the PE ratio. So I combine the best bit of the PE ratio with the best bit of the DCF. And that's just a bit geeky of me to say that, but that's basically how I do it, right? So it's a bit different. I hope that makes sense to the 1% of people who are interested in that, but that's how we do it. Okay, so let's finish with a quote. This quote came from, I think it was from this book here. I'll just bring it up. The quote was from this book here, from Black Belt, and it says, "The harder I work, the luckier I get." It's from Samuel Goldwyn. So the harder I work, the luckier I get. And the reason why I wanted to include this quote is because a lot of this stuff that we talked about tonight seems really hard and it seems really technical. But if everyone finds it hard and everyone finds it technical, basically that's your advantage. If you're willing to work harder than someone else, that is your advantage. And we see this in all walks of life, not just in investing or finance. We see this in all walks of life. If you work harder, typically you put yourself in a better situation, typically. And obviously there's a limit. We've got things like mental health and all of these things that we want to take care of. But at the end of the day, if you work harder, you tend to slowly become more lucky. You tend to. It's not always the case, but you tend to. And I think that's a good quote for tonight. And so in the next few weeks, guys, we're going to be coming back with basically some all-stars. I'm recording this from Bali. Next week, I'll be back in Sydney I know last week I was in Sydney, this week I'm in Bali, next week I'm in Sydney. Sooner or later I'll be recording from my office in Melbourne or even from my home. One of these months I'll be back at home. I got to tell you, it's not that glorious traveling for work, but it's the things we have to do when we run our own business. Anyone that runs their own business in the chat will know exactly what I'm talking about. There are things you have to do. Even people that don't run their own business that have to travel for work, it's not as glamorous as it seems. But in any case, I'll be recording next week from Sydney. I think we'll have Chris. I could be wrong, but we may have Chris next week. I'm hoping to track down Sam Huppert, Dr. Sam Huppert, who I would say is probably he's easily one of the best CEOs in Australia, easily, because he's got the best performing company in Australia. So you'd have to say he's done something right. So we'll have him on the show